Hello and welcome to the Genuine Learning Blog. I'm Peter Zender and buckle up because today we're talking about environmental credits, aka where companies pay to offset pollution and accountants are trying to offset the confusion around this area. So let's take a look at the proposed ASU related to topic 818. So a little background before we dive into the proposal. So the government has set up incentives to encourage companies to reduce emissions, cut pollution, and use less energy by granting them environmental credits. Now, some companies play it safe. They keep their emissions below the required thresholds, and they never really have to use these credits. They can basically hoard and hold them. Other companies, they take more of a put in my tab kind of approach where they're exceeding limits and they're needing to buy credits from others in order to stay compliant. And this imbalance creates a supply and demand. Surprise, surprise, these credits start trading on a secondary market. And if there's a secondary market, that means that these credits have value. But the problem for us accountants up until this point is that there really hasn't been any clear direction on how to value, record, or account for these properly. So enter this new proposal issued on December 17th. So as we dive into the proposal, the first thing I want to look at is the definition and scope. So what exactly are environmental credits? Well, the definition says they are enforceable rights represented to prevent, control, reduce, or remove emissions or other pollution that are separately transferable in an exchange transaction. So from a scope perspective, these can be credits that have been purchased, granted, or self-generated. They cover both compliance-related credits, the ones that you are required to have, that you have to have, and voluntary credits, where maybe a company is raising their hand, trying to get these, just wanting to flex their green credentials. The key here is that they have to be related to emissions or other pollution, and they have to be separately transferable credits. If we move to recognition of assets here, so when do we actually recognize these from an asset perspective? If you are a company who has received credits, there are two scenarios that you would recognize them. The first is if you plan to use them to comply with regulations and requirements. The second is if you plan to exchange them or sell them. So basically, are you going to use them or are you going to exchange them or sell them? You have to be in one of those two scenarios. Otherwise, these credits go straight to expense. What about measurement of assets here? So from that perspective, this proposal outlines different measurement treatments for compliance and non-compliance credits. So compliance credits, again, those are the ones that are tied to regulatory requirements. These would be recorded at cost and not tested for impairment. Not tested for impairment. The reasoning is that if you tested them for impairment and recognized a loss, you'd essentially be recording a compliance expense on the income statement prematurely, which is not the intent. On the flip side, for non-compliance credits, if you don't have that matching compliance expense, so this is where you would perform impairment testing to reflect potential declines in value. And there was even a curveball thrown in where if the credits you're holding were obtained through an exchange or non-reciprocal transfer, you do have the option to use fair value measurement as an alternative. The reasoning here being, or the rationale, is that fair value provides a more accurate presentation of their intended use, right? If the company is actively trading these credits. All right, let's move to the obligation side here. If you have a requirement or an obligation, you recognize a liability when emissions trigger a compliance obligation. Translation, you go over the limit. So if you go over the limit and you already have environmental credit assets on hand, then the liability is just measured at cost, the cost of those credits. If you're short on credits and you need to fill a gap of some sort, you have to use fair value based on the secondary market price, since that reflects the additional cost that you'll incur to get back under the threshold. So if you have credits on hand, measured at cost. If you're short on credits, filling the gap, that's where you would use fair value based on that secondary market price. All right, let's talk presentation and disclosure. So how should environmental credits appear on the balance sheet? Well, the proposal says keep them separate. Assets credits owned stay on one line, liabilities, credits owed stay on another. The board determined this separation gives investors a clearer picture of a company's rights and obligations. Now, what about disclosure? So there are going to be some requirements that you have to include if they are applicable. Those include major environmental credit holdings, impairments, and fair value disclosures for non-compliance credits if you're using fair value, cash spent on credits, and then revenue gains and losses from credit sales. So it's going to kind of be a checklist here based on the proposal for disclosures that you would need, again, if they are applicable. All right, what's the expected impact here? Really, the hope is here that they improve comparability and transparency. So giving investors and regulators a clearer picture of environmental credits. And on the flip side too, hopefully they help us as accountants by bringing a little order to the accounting chaos, right? Removing the wild west element that we're kind of in right now with respect to this area. So trying to set some consistent rules for recognition and measurement. And to get that consistency in place, the proposal says that we would use retrospective application. So we would apply these things retrospectively with a cumulative adjustment, kind of looking back to move forward, if we'll put it that way. So what are our next steps here? We've covered kind of the main tenets of the proposal. If you have feedback for this proposal, maybe you're a net presentation advocate and you think assets and obligations should be reported together. Maybe you're thinking, how dare you make me impair voluntary credits? Either way, make your voice heard. You need to submit your feedback by April 15th, and we'll include a link to the proposal and the FASB submission page in the comments below. But that's it. That's all I got for this accounting knowledge credit. Whether you hold on to it or trade it on the secondary market, that is up to you. Since this was voluntary viewing, feel free to measure it at historical cost less impairment or fair value, whichever makes you look better. But I'm Peter Zender. Thanks for tuning in. Happy debiting and crediting.